You just cashed out some gold coins. Maybe you bought them years ago, watched the price climb, and finally decided to lock in the win. Smart move, right? But now there's this nagging question sitting in the back of your mind. Does the IRS need to know about this? And look, I get it. You've probably gone down the rabbit hole online. You've seen the forum posts, the YouTube comments, the confident assertions from people who swear they know the system inside and out. Things like, American Eagles? Totally exempt. Keep it under 10 ounces and you're fine. If nobody sends you a form, there's nothing to report. Pay cash, no trace, no problem. Here's what makes this complicated. Some of those people aren't trying to mislead you. They genuinely believe what they're saying. And honestly, I can see why. The rules around precious metals reporting are confusing, outdated, and frankly, kind of a mess. But confusion doesn't make something legal, and believing something doesn't make it true. So here's what I want to do in this video. I'm going to walk you through what the actual tax code says about selling gold and silver, what it doesn't say, and where the massive gap exists between legal obligation and practical enforcement. Because there's a huge difference between what you're required to do by law, what triggers automatic reporting, and what people assume is some kind of secret exemption. My goal with this channel is to cut through the noise and give you accurate information so you can make better decisions. I'm not a tax professional, I don't have clients, and I'm definitely not your personal advisor. This content is purely educational. It's here to inform, not to tell you what to do. If you own physical precious metals and you've made real money on them, this is one of those topics where bad information doesn't just cost you sleep, it can cost you serious money. Always talk to a qualified tax professional about your specific situation before making any decisions. How gold and silver actually get taxed. All right, let's start with the part that surprises almost everyone. How the IRS actually categorizes physical gold and silver. Because if you're thinking they treat it like stocks or mutual funds or maybe real estate, you're already on the wrong track. The IRS doesn't see your gold bars or silver rounds as investments in the traditional sense. Instead, they classify physical precious metals as collectibles. Yeah, the same category as rare stamps, vintage baseball cards, and fine art. And that classification, it changes everything. Here's why this matters. When you sell most investments, stocks, index funds, rental property, and you've held them longer than a year, you're looking at long-term capital gains rates. For most people, that means 0%, 15%, or maybe 20%, depending on your income bracket. Pretty straightforward. But collectibles? Different ballgame. The IRS says gains on collectibles can be taxed at a maximum rate of 28% for long-term holdings. Now, I need to stop right here because this gets twisted all the time, and the misunderstanding leads to a lot of unnecessary panic. That 28% figure is a cap, not a guarantee. You don't automatically pay 28% just because you sold some gold. What actually happens is this. Your gain gets taxed at your normal capital gains rate, but unlike stocks, the ceiling is higher. If you're in a lower bracket, you might pay 15%. If you're in a higher bracket, you could hit that 28% ceiling. The point is, you're starting from a disadvantaged position compared to traditional securities. And if you sell within 1 year of buying, forget capital gains treatment altogether. That profit gets taxed as ordinary income just like your paycheck. No special rates, no preferential treatment. It's the same as if you earned it at your day job. So right from the start, before we even touch reporting requirements or enforcement realities, you need to understand this. Physical gold and silver come with a built-in tax penalty compared to most other investment assets. That's not an opinion. That's how the tax code is written. Once you wrap your head around that, a lot of the myths start to unravel. Because most of the loopholes people talk about don't change this fundamental classification. There's no magic coin type, no special bar weight, no transaction amount that converts your gold from a collectible into something else. Under current law, gains on physical precious metals are taxable. Period. Which brings us to the question everyone actually wants answered. If it's taxable, how does the IRS even find out you sold it? The Form 1099-B confusion. This is where things get messy. This is where most of the myths are born, and this is where people make dangerous assumptions that can come back to bite them later. You've probably heard about Form 1099-B. It's the form brokers and dealers use to report investment sales to the IRS. When you sell stock through your brokerage account, boom, 1099-B shows up in January. The IRS gets a copy, you get a copy, everybody knows the transaction happened. But here's what trips people up. Not every precious metals sale triggers a 1099-B. In fact, most don't. And when people don't receive that form, they jump to a conclusion that feels logical, but is completely wrong. They think, no form, no reporting requirement. Let me be crystal clear about this because it's the single most important distinction in this entire conversation. Form 1099-B is not about your tax obligation. It's about a dealer's reporting obligation. Those are two separate things. When a dealer files a 1099-B, they're telling the IRS, hey, we facilitated this sale. Here's who sold, here's what they sold, here's how much they received. It's third-party confirmation. When a dealer doesn't file one, there's no automatic alert going to the IRS. No paper trail gets created. But, and this is critical, that doesn't erase your legal obligation to report the gain. Our tax system operates on something called voluntary compliance. You are legally required to report taxable income whether or not you receive a tax form documenting it. That's not optional. That's not a suggestion. That's the foundation of how the entire system works. Now, if you start researching this online, you're going to find a lot of very confident people posting very specific claims. Charts showing reportable versus non-reportable coins. Exact ounce thresholds. Blog posts claiming certain silver products are exempt. And honestly, most of that is either outdated, oversimplified, or just flat out wrong. So I did what any nerdy tax person would do. I pulled the actual IRS instructions for Form 1099-B, not a blog post summarizing them, not someone's interpretation. The actual document dealers are supposed to follow. And you know what the IRS actually says? They focus on regulated futures contracts. In plain English, the IRS says a precious metals sale generally only requires a 1099-B if it involves a metal that trades on a regulated futures exchange, and the quantity sold is large enough to match a minimum futures contract size. That's the test. That's what dealers are looking at. And if your sale doesn't meet that threshold, no 1099-B gets filed. But here's what you won't find in those instructions. Any mention of exempt coins. No list saying American silver eagles are off the hook. No guidance about constitutional 90% silver triggering reports at $1,000 face value. I searched. I read the whole thing. That language isn't there. What the IRS does include is something else people conveniently ignore. They explicitly state that sales within a short time period should be aggregated. And if a dealer knows or has reason to believe someone is structuring transactions to avoid reporting, the exception doesn't apply. That's straight from the IRS. So when you hear someone rattling off exact coin types, precise ounce limits, or saying, just stay under this magic number, understand what you're really hearing. You're hearing industry folklore. You're hearing generalizations that may have started from a kernel of truth, but got twisted through repetition. And even when no 1099-B is filed, even when no third-party report goes to the IRS, the underlying tax rule doesn't change. A taxable gain is still a taxable gain. The law doesn't say, report it only if we catch you. It says, if you have taxable income, you must report it. The part nobody wants to say out loud. All right, we need to talk about the elephant in the room. And I'm going to approach this carefully because it's where things get uncomfortable for a lot of people. Whether you agree with it or not, the US tax system runs on voluntary compliance. The IRS doesn't have cameras in your basement. They're not tracking every transaction you make. The system relies heavily on third-party reporting, banks, brokers, employers sending in forms, and on people self-reporting their income honestly. That's just reality. That's how it works. And physical assets like gold and silver? By their very nature, they don't generate the same automatic paper trail that stocks or real estate do. You can buy a silver bar with cash from a local dealer, hold it for 5 years in a safe, sell it back for cash, and walk out the door. No digital record, no 1099, no W-2, nothing. Because of that reality, there are people out there, probably a lot of people, who own precious metals and have zero intention of ever reporting their sales. And look, I understand why that happens. Some folks fundamentally don't trust government institutions. Some value privacy above almost everything else. Some see physical metal as real money or insurance against the system collapsing, not as an investment subject to tax rules. And yes, some people operate under the belief that if something isn't automatically reported, it's unlikely to ever become a problem. I'm not here to judge any of that. Everyone's got their own risk tolerance, their own worldview, their own reasons for doing what they do. But here's what doesn't change. The IRS position on this is not dependent on their ability to enforce it. The law doesn't say, report your gains only if we can easily verify them. It says, if you have taxable income, you are required to report it. Full stop. Whether someone chooses to follow that or not isn't a tax strategy. It's a personal decision that comes with risk. And risk runs in both directions. Here's what I mean. Most IRS audits don't start because someone flagged your gold sales. They start somewhere else entirely. Maybe a bank files a currency transaction report because you deposited $15,000 in cash. Maybe you get audited for something completely unrelated, a business deduction, a rental property, whatever, and suddenly they're looking at everything. Maybe there's a mismatch between the lifestyle you're living and the income you're reporting. When any of those things happen, the burden of proof doesn't shift to the IRS. It stays with you, the taxpayer. You need to explain where money came from. You need to justify deposits. You need documentation. And if the IRS determines you underreported income, especially if it looks intentional, penalties and interest start compounding. The statute of limitations might not even start running if there's evidence of fraud. We're not talking about a slap on the wrist. We're talking about years of back taxes, penalties that can double or triple what you originally owed, and potential criminal exposure in extreme cases. Again, I'm not trying to scare anyone. I'm just drawing a clear line between what the law requires, what gets automatically reported to the IRS, and what some people choose to do anyway, knowing the risks involved. If you're comfortable with that risk, that's your call. But don't confuse it with legitimate tax planning. They're not the same thing. Before we move on, if you're finding this breakdown helpful, hitting the like button and subscribing really helps the channel grow. It tells YouTube to show this content to more people who need it. Thanks for that. Strategies that actually reduce your tax bill legally. Now, if your goal is to minimize taxes without rolling the dice, this is the section that matters. I'm going to keep this practical and high level, but these are real planning tools built into the tax code. Number 1, timing the sale. This is the most basic lever you have, and it's wild how often people ignore it. If you sell physical gold or silver that you've held for less than a year, the entire gain gets taxed as ordinary income. That could be 22%, 24%, even 37% depending on your tax bracket. It's the same rate you pay on your paycheck. But if you hold that same metal for just over 1 year before selling, you shift into long-term capital gains treatment. Yeah, you're still subject to the collectibles rules we talked about earlier, so your rate cap's at 28% instead of 20%. But for a lot of people, that's still better than ordinary income rates. That one decision, waiting a few extra months to cross the 1-year threshold, can save you thousands of dollars. It's not sexy, it's not clever, but it works. Number 2, where you live matters more than you think. Federal taxes are only part of the equation. State taxes can absolutely wreck your returns if you're not paying attention. Some states tax capital gains as ordinary income, which means they're stacking their rate on top of whatever you're paying federally. Some states have no income tax at all, which means your only concern is the federal bill. Some states even tax bullion purchases on the front end with sales tax, which eats into your returns before you even start. Just understand that once you sell, the tax consequences are locked in. You can't unring that bell. So if you're sitting on significant gains and you have flexibility about when or where you sell, Location is worth considering as part of the equation. Number 3. Retirement accounts can change the game. This is one of the few legitimate ways to sidestep the collectibles tax problem entirely. And it surprises a lot of people because they don't realize it's even possible. Under current law, certain retirement structures allow you to hold physical gold and silver inside the account. The most common example is a self-directed IRA, and if you structure it correctly, especially with a Roth IRA, the tax advantages are massive. Here's how it works. With a Roth IRA, you contribute money that's already been taxed, so you're not getting a deduction up front. But once that money is inside the Roth, growth is completely tax-free. And when you take qualified distributions later, assuming you follow the rules, those withdrawals are also tax-free. So even though gold and silver are normally treated as collectibles with that 28% cap, that classification becomes irrelevant when the metal is held inside a properly structured Roth IRA. You can buy low, sell high inside the account and never pay capital gains tax on the appreciation. Now, this isn't a free-for-all. There are strict rules. You need an IRS-approved custodian. The metal has to meet certain purity standards. It has to be stored in an approved facility. You can't just keep it in your personal safe. And there are fees involved for custody and storage that eat into returns. But from a pure tax perspective, this is one of the cleanest strategies available for avoiding the capital gains hit on precious metals. Number 4. Documentation is boring, but it saves you later. Nobody wants to talk about record keeping. It's not exciting. It doesn't feel like strategy. But I'm telling you right now, this is where a lot of people hurt themselves without realizing it. Cost basis matters. Purchase dates matter. Documentation matters. If you can't prove what you paid for something, when you bought it, or how much you sold it for, you're already in a weak position if questions ever arise. Good records don't just reduce your tax bill, they reduce stress. If you ever need to reconstruct a transaction, explain a deposit, or defend a position, memory won't cut it. You need receipts. You need invoices. You need bank statements showing what went out and what came back in. It's boring. It's tedious. But it's the difference between having leverage and scrambling to piece together a story years after the fact, bringing it all together. Let me tie this whole thing up because we've covered a lot of ground, and I want to make sure the core message doesn't get lost. Physical gold and silver exist in a strange corner of the tax world. The IRS classifies them as collectibles, which means higher potential tax rates and different treatment than stocks or real estate. There's widespread confusion about reporting requirements, and a lot of that confusion comes from misunderstanding what Form 1099-B actually does. That form is about dealer reporting obligations, not your tax obligations. No form does not mean no tax. The IRS hasn't published some secret list of exempt coins or safe transaction amounts the way the internet wants you to believe. What they have published is a narrow technical standard for when dealers must file 1099-Bs, and it's based on futures contract thresholds, not coin types or marketing claims. At the same time, we all live in the real world. The tax system runs on voluntary compliance. Enforcement isn't perfect. Physical assets don't create automatic paper trails. Some people will choose not to report their activity, and that's a decision they've already made for themselves based on their own risk tolerance. But it's crucial to understand that the legal obligation doesn't disappear just because detection is difficult. That's not planning. That's gambling with consequences you may not see coming until it's too late. If your goal is to reduce taxes within the rules, there are legitimate tools available. Understand holding periods. Be aware of state tax exposure. Use retirement structures intelligently. Keep meticulous records. These aren't loopholes. They're just smart use of the tax code as it's written. There are also more advanced strategies people talk about, like loaning out metals instead of selling them, or using installment sales to defer gains. But those come with their own complexity and risks, so I've intentionally left them out of this conversation. One last thing worth mentioning: step up in basis at death. Under current law, when someone inherits assets like gold or silver, the cost basis resets to the fair market value on the date of death. That can completely eliminate capital gains for heirs. It's not a loophole. It's just how inheritance works under the tax code. But it's something to keep in mind if estate planning is part of your picture. My job with this channel is to break down what the IRS actually says, what it doesn't say, where the myths come from, and where the real risks hide. What you do with that information is up to you. But if you own physical precious metals with real gains, you owe it to yourself to understand the rules clearly. That's the difference between just holding assets and actually managing wealth intelligently. Let me know what you think about reporting gains on precious metals in the comments. Or maybe yours were lost in an unfortunate boating accident. Either way, I'd love to hear your perspective. If you want to stay ahead of what's happening in the precious metals market, check out the video I've got linked right here. Thanks for watching, and I'll see you in the next one.